Okay, so this is the last part of the module. So this video lecture will be discussing about transfer pricing and the multinational firm. So in our previous video lectures in the introduction part or introductory part, so we've learned that decentralization and responsibility accounting normally is common among multinational companies or MNCs. So that's why it is also common for them to encounter transfer pricing problems. Okay, so for the multinational firm, transfer pricing must accomplish two objectives. So, number one, it must be a performance evaluation, basis for performance evaluation, and the optimal determination of income taxes. Okay, because in this case, buying and selling transactions can affect the taxes that is being paid also by the multinational company. So if all countries have the same tax structure, then transfer prices would be set independently, okay, without regard of the income taxes. However, there are this is or however the case is, we have different income taxes, okay, for the different countries. So there are high tax countries and low tax countries. So as a result, the MNCs may use transfer pricing to shift the cost to their high tax countries, because in this case, they are just producing. Okay, cost centers should be placed on high tax countries because they do not generate profit or revenue. And the revenue centers, they will shift that to low tax countries, because in this case, since they are generating revenues, so if there are lower taxes or tax rate, then therefore if they have higher revenues, they would still pay lower income tax. Okay, so this is how they utilize the transfer pricing. So there are three pricing methods that approximate an arm's length pricing. So number one is a comparable uncontrolled price method. So this is normally the market price. Okay, the second is the resale price method, in which this is equal to the sales price received by the seller or reseller less an approximate markup. Okay, so in this case, this is applicable for subsidiary purchasing a good for resale and then sets their transfer price equal to the resale price less the gross profit percentage. Okay, and the third is the cost plus method, which is the cost based transfer price. Okay, so to understand better for MNC setting, so we will use this illustration. Okay, so ABC Incorporated has a number of divisions around the world. So Division B is located in the US. So they purchase a component from Division C, which is located in Canada. So the component can be purchased externally for $38, and the freight and insurance on the item is $5. However, there is commission of 3.8, so need not be paid. Okay, because in this case, if this will be made a sale internally, then commission should be disregarded. Okay, so to analyze comparable uncontrolled price or the market price. Okay, so however, we will add the freight and insurance, and we will deduct the commission. Okay, so the comparable uncontrolled price or the market price for this transfer is $39.2. Number two, what about if there are no outside market for Division C and a resale price for Division B? Okay, so the transfer price will be set as follows. So we have here transfer price, which is $42. Okay, minus the markup percentage times the transfer price. So in this case, the markup price is 1 or 40%. Okay, so in this case, that's 140 or 40%. So based on the resale price, the transfer price will now become $30. Okay, so you just get the markup based on transfer price. And okay, so what about for cost plus transfer? So manufacturing cost plus the freight and insurance. So the manufacturing cost is 20 plus our freight insurance of 5. So the transfer price under this method is $25. Okay, what about if freight insurance decreased by 1%? So the comparable uncontrolled price and the cost price would be lower also by $1 because we incorporate it in determining the transfer price. Okay, this is how MNCs normally set their transfer price, or if they have other policies for setting it, okay, they can also do that. Okay, so this is for transfer pricing and the multinational firm.